Good evening, everyone. Thank you for joining us on this Brick by Brick session. The topic for today's session is the Atomberg story, lessons in brand building on first principles. We have with us Arindam Paul, CBO and founding member of Atomberg. He's seen the journey from inception to recently when they clocked 100 crore revenue. It's a brand that's been built in a very capital efficient manner and I think is well on its way to become a category defining brand. Arindam is one of my favorite LinkedIn and Twitter follows. I think he's literally open sourced the playbook that helped them get here. And, thanks for that, Arindam. I think, that's like great service for the ecosystem and super excited to have you here with us.
Thank you for having me here. I think pleasure to be with you guys and share whatever little I know.
No, perfect. So, you've published a lot and it was a hard challenge figuring out what we should focus on. So I've picked up 4 areas given we just have 1 hour. It will be Amazon, offline, brand building, and org culture. So let's start with Amazon. We know that you initially started your journey in the B2B channel and then forayed into Amazon. Talk us through the journey to win the trust of the customer on Amazon and, especially in a category like fans, which is a big ticket item. How was that journey, in terms of triggering trial, which is however you think about it?
Yeah. So I think we started selling fans from October 2015. So started off with B2B for about 6 to 7 months. I think we did exclusively B2B, selling to schools, colleges, different industries, primarily the ceramic industry in Saurashtra. Did it for about 5-6 months. And very soon we realized that B2B, you will soon hit a peak, right? So at the end of the day, if you really want to build a big business, 95% of fans in India are installed in consumer households. So you need to reach consumers, and there was no at that point for us other than e-com and D2C, right? And at that point, D2C was not even a buzzword. I think it didn't exist. That did not exist in 2015-16 when we were starting. So what we did was we had a website in place, a functioning website. So had the product on the website and listed the product on Amazon. I think at that point, even on Amazon, the category was just taking off at that point. So it was a fairly small category, and people could not imagine that fans could become such a big category at that point. But I think there were 2-3 lead indicators. So one was at that point, people were becoming more and more comfortable buying stuff from Amazon or e-com, right? So how the e-com wave had happened was it started with books. Then it moved on to mobile phones in 2013-14, mobile phone and fashion. And then 2015-16 is when appliances and everything else, right? So that was one trend. The second trend was a lot of digitally influenced sales were happening. So looking at Google searches online and all. So even though there were no sales that were happening online, the searches were increasing year on year. So I think that gave us a saying, and anyways, we didn't have any other option, right? We couldn't go offline at that point. So that's why I decided saying, let's launch on Amazon and let's have the product on the website. Now, the interesting thing is, right, how consumer behavior evolving at that point was there was this set of early adopters, right? For whom excitement was more important than trust. So yes, trust is very important. But if you look at the innovation curve, right, there will always be that 1%, 2% of audiences in any segment whom you call innovators or early adopters. They really want excitement in products. And I think this was a category that had not seen any excitement for 60, 70 years. It was the same old fan. And we had a product that had a remote control. So that was the hook. The hook was the remote control. Energy efficiency, everything else came layered on top. Even though the core USP was energy efficiency, but for the early adopter, the hook was the remote. Saying, here is a fan that comes with a remote. I will install it in my homes. I'll show it off to whoever comes. And so I think that was what had helped us get the initial sales. And of course, Amazon by that point had built that brand saying, if you don't like the product, you can always return it back in 10 days, 15 days, and so on and so forth. But for the early users, and I see this for any category, especially when you start, I've seen this behavior that the product needs to be exciting for people, especially for the innovators who would have an innovator mentality in that all of us know the cycle, right? Innovator, early adopter, early majority, late majority, and laggards. So if you're able to highlight excitement and communicate excitement, I think that really matters a lot in the initial 0 to 1 journey.
Interesting. So you're saying just the fact that you had a remote
control fan, it was a unique product. Yeah.
Okay. And that was enough. And Amazon, one of the other questions I had was how, whether you had to like give any free trial period, etc. That you're saying Amazon.
Yeah, Amazon takes care of it. So I think there is, in our category, I think there's this 10-day return. If you do not like it, you can return it within 10 days.
Okay. Got it.
So I think in mattresses, you have the 90 days. Because we were selling on Amazon, the trust was already there on Amazon. They did not trust Atomberg. They found the product exciting, but they trusted the platform. And that was the reason why we did not bet big on D2C. Because then you were trying to do two things. You were getting people to try and trust where they are purchasing from, as well as trust the brand, which was a difficult battle to fight at that point of time. And that's a conscious decision that we had taken, saying we'll build excitement with the product and let people trust Amazon and buy from Amazon.
Okay. And, and so you started selling. And when do you think you hit product market fit? Or, I know you like to call it product price market. So when was that moment?
I think, we launched, early 2016 or so, right? And it was over 2016 when this Great Indian Festival, right? When that sale happens. And we ended up doing 500 fans in that month. And at that point, 500 fans was too big. And that is when we realized we are onto something. And now there are indicators, right? So we launched, in around March, and then month on month, we are seeing some indicators. And that's why I tell how do you measure whether you understand you have PMF or not, especially on Amazon, right? The first metric was the ads were becoming more effective. So say, for example, today, if your ads conversion rate was 2%, the ads conversion was becoming 3%. So the ads were becoming more effective month on month. Second is your ratings and reviews are consistently improving. So month 1, you would have 5 reviews, 2, you would have 10, 15 reviews, and the ratings were 4.3, 4.4 and all. The third was, in the first month, because we will not have any organic discovery, right? But slowly and gradually, your organic discovery also increases. So reliance on ads, for example, on the first month, 90% of your sales will be ads driven. But in 6 months, I think we had reached a point where only about 70% of our sales. So there's a decreasing trend on the dependence on ads. Mm-hmm. And the fourth was the overall conversion rate. So overall conversion rate, as your ratings and reviews increase, and I like to call it Amazon flywheel, how that flywheel works. Mm-hmm. So I think these 4 things indicated that we have a strong PMF. And the moment we had hit this 500, 600 fans in a month, and at that point it was big. I think we were doing around 2,000 fans a month, and 30% of our sales are coming from Amazon at that point. Mm-hmm. So I think that was when we realized that we have not a very strong PMF, but at least the indicators are right. We can improve and build upon it, because the fundamental metrics are all moving in the right direction. Mm-hmm. So, and in fact, the first product, right, it did not look good. It was a very plain vanilla fan. It was built for B2B. It was built for hospitals, colleges, schools and all. So it didn't look good. And that's the feedback we were getting from consumers. In the reviews, the feedback was saying, you have a very good product. I like the technology, savings are there, remote is there, but the looks are not good. That is actually a feedback that we took and brought the next product, which is today our flagship product and contributes to more than 50% of the sales.
Got it. But is there just in terms of absolute figures, any thumb rule that you have in terms of number of reviews? What should be it shouldn't be 4-star, 5-star in terms of ratings, etc. to get a handle on whether you have product market fit?
See, I think it depends on the product and the price, right? Say, for example, if you're selling a premium product, in our case, we are 2x of the competition. So we had to be 4.3 plus. So it had to show 4.5 star. So anything more than 4.3 shows 4.5. So I think for a premium product, if you are not a 4.5 star rated, then it's very difficult to scale from a rating point of view. Mm-hmm. So we were obsessed with ratings then, we are still obsessed with ratings even today. Saying if the product is, and that's how we decided a lot of products. We launched a lot of products. If it doesn't fit in that, we kill it. And I think the same metrics hold true for every product launch. You launch a product or you launch a brand, month 1, your dependence on ads will be very high. So 90% of your sales will come from ads. Mm-hmm. So that 90% has to come down to 70%, 60%. So that decreasing trend has to be there. Mm-hmm. And the second thing is your ads need to become more effective. So whatever sales you are getting from your ads has to become more effective with time. The conversion rates has to improve with time.
Right.
So if you're able to do these 2 things, if these 2 metrics are right, that means you have a strong PMF, and then it's only about
Figuring
out how big the TAM is. If the TAM is big enough, then you'll keep scaling.
Got it. To give some sense to people on what the gold standard is like, for instance, on dependency on ads, right? You said it starts with 100%. In best case, what's like the gold standard in your view, that percentage term?
See, it depends, right? I think in our case today, I think ads-driven sales will be 20%. So if I turn off ads, 80% of sales will still continue to happen.
Right.
So I think it's a virtuous cycle, and I don't think you want a gold standard. I think you just need to keep pushing the limit to as much as you can without impacting the growth, right? So I don't think there's any number to it, whether it is 20 or 40 or 60, it will depend on the category and the competition.
Right.
But the trend has to move in the right direction.
Right.
All of a sudden, if you see that your organics are coming down, that means your flywheel has stopped working, or it has stopped and some other brand has taken your share and their flywheel has started moving.
Right. And, now moving to the other part that you mentioned, which is around marketing efficiency improving over time.
Yeah.
I always found that interesting because, if I look at the journeys of brands in our own portfolio and others we've seen, that is something that always comes under pressure as people scale. It's almost as though if you're able to maintain your early stage marketing efficiency, it's a job fantastically well done. You're talking about improving marketing. So two things, maybe we can start with, do you have a view on why the other brands, most of the brands are struggling on that front? And the second thing is just talk us through, how you managed it at
I'll tell you the main reason is there are a few channels which are compounding channels and there are a few non-compounding channels. So I use this term. So compounding channels are channels where with scale, things improve. So Amazon is a compounding channel. The trade is a compounding channel. Exclusive brand outlets are compounding channels where you get operating leverage at scale, right? Or you have a flywheel that kicks in motion. A lot of brands which have high dependence on D2C, right? So D2C is a non-compounding channel. Yeah. So in Amazon, what happens, right? I'll run you through Amazon and I'll tell you how marketing efficiencies improve. So on day one, you start with ads because without ads, you don't get any traffic. So you drive that traffic through ads on the product page. On the product page, initial days, your conversions will be low, right? Because you don't have any rating history. No one knows your brand. So it's a cold start problem. So initial days, you need to put a lot of money to get the ball moving. So you get some sales. If your product is good, you start getting good reviews. So the moment your ratings and reviews start improving, your conversions will slowly and gradually improve. So your ads start getting more efficient. So maybe your conversion rate on day one will be, say, 0.1%. After some months, it will reach a point of 1%. You will also start doing a lot of off-platform activities, right? Off-platform brand building activities. There will be word of mouth and all of this, which will result in people coming and searching for your brand on Amazon. So the moment your brand searches increase, automatically, you don't need to pay for those, right? But people are coming searching for your brand. So those are much more efficient. Once all of this starts happening, right, your sales velocity also starts increasing. Now, how the Amazon algorithm works is the more a product sells, say, for example, ceiling fan, right? We are selling ceiling fans. We are already the number one in ceiling fans. So if someone comes and searches the keyword ceiling fan, organically, Amazon will rank me on top, right? And that is where the efficiencies kick in. And that's why I said why you should get efficient with scale. Now, when you look at any other channel like D2C, right? Unless you have very strong brand affinity and people come look for your brand, organically come looking for your brand, search for your brand and come to your website, you are always in the mode where you have to pay to acquire consumers. So in Amazon, if you're able to get into that flywheel, you move away from that where you continuously do not have to pay to acquire consumers. And the moment that
interrupt, Arindam, sorry. My question was actually on Amazon only because I was wondering whether it is a function of competitive intensity, because we know of personal care brands that were sort of in that virtuous cycle for a while, but all of a sudden, even their efficiencies are coming under pressure. Is it a function of competitive intensity that...
See, competitive intensity will always be there. I think it's there in our industry as well. So I think competition impacts your CPCs, right? So when you look at ads efficiency, there are three things, right? One is your organic discovery or organic discovery / brand searches, right? If your organic discovery and brand searches are high, you don't need to pay anything for those orders. The second parameter in the ads efficiency is the CPC. Now, CPC is a function of competition intensity, right? So whether your CPC is 20 or 100 or 200 is decided by competition. And the third is your conversion rate. Now, conversion rate again has nothing to do with competition. If you have the right product, right price, right ratings, of course, your conversion rates will keep on improving. So out of three parameters, one parameter is basis competition intensity. The other two parameters are independent of competitive intensity. So if the other two parameters are right, if you are doing enough things outside the platform to build brand awareness, if you are ranking high organically on few keywords, and then you just need to maintain it. So in our case, right, so our share of spends on Amazon will be 5%. So it's not that, and our market share will be say 3x of that. So that can only happen if these efficiencies kick into. And there are multiple ways to optimize. So I think that's the framework that I used to look at. So there is one parameter which is not in your control. So instead of looking at say whether my ROAS should be 3 or 4, maybe I say these are two parameters which are in my control. These are the third parameter, which is basis competitive intensity, which let competitive forces decide what the CPC is. Right. And irrational competition might be there for 6 months, 12 months, 18, 24 months. They'll not be there forever.
That I completely swear by. Now, that's an interesting way to break it down and how to think about it.
Yeah.
Now just sticking to the pre-PMF journey of brands, the biggest questions that founders are always solving for is how fast should I grow? And second is just capital allocation in terms of marketing dollars, right?
Yeah.
So someone in the pre-product market fit phase, how do they think about it? In terms of revenue targets and marketing spends that they should incur before the PM.
Yeah. So I think this is I don't think there'll be a rule of thumb for this to arrive at it. But I think what most people get wrong or don't get it right is people overestimate TAM. So in a lot of cases. So I think TAM is a reality, right? And how I define TAM is like, you cannot be too flexible with TAM. Say, for example, if I'm selling a 3,000 rupees fan, I cannot just say that every fan sold is my TAM. Because there are fans sold at 1,000 rupees, there are fans sold at 1,200 rupees. Now, I cannot get a 1,000 rupee consumer to upgrade to a 3,000 rupees fan. So defining TAM as per the price point cut, I think that is very critical to have a realistic understanding where we are. So how we look at it is usually by year one, can we get to around say 5 to 10% of the TAM? So for example, say if there are 100 fans which are sold greater than 3,000 rupees, can I at least sell 10 fans within a year? And to get to 10 fans, how much do I need to spend? I think CPCs are available, publicly available for any advertiser. You calculate, you build a model wherein you put in the CPCs. CPCs don't change. CPCs will only increase with time. Your conversion rates will improve with time. And your reliance on ads will keep coming down with time. Say, for example, month 1 will be 90%, month 2 it will be 80%. So using these three, you can actually create a model which will arrive saying to reach 10% of my 10% market share in my TAM, this is what I need to. Now, whether it is 10% or 20% or 30%, that depends on the risk appetite and the capital allocation that the brand would be able to do at that point of time in their journey. If it's a bootstrap brand, maybe that will be 10%. If it's a funded brand and the mandate is to grow fast, maybe that could go up till 25 to 30%. But a lot of people overestimate TAM. They would say that my TAM is the whole category and not this price point category. And that's where you end up bleeding and you end up attracting bids on keywords where you should not bid for. Say for example, if I take the example of fans, right? I would never bid for a ceiling fan. So economy would always be a negative keyword for me. Now that could be a high volume keyword, but I totally understand that is not like if I bring in that audience, my marketing efficiencies will go down.
Yeah. No, that's interesting. Yeah. Knowing what you shouldn't know is as important. What you shouldn't be doing.
Yeah. So I think overestimating TAM is a big, you should not be too rigid with TAM. I think people are flexible to a range of 20 to 25% in most categories. I think someone who had a budget of 2,500 with the right inputs, maybe they'll upgrade to a 3,000 rupees. But someone with a 1,000 rupees budget will never upgrade to a 3,000 rupees come what I do.
Sure. And okay. Now, moving on to the post-product market fit phase.
Yeah.
Actually, one more question in the pre-product market fit phase. Yeah. You spoke about launching multiple products and then killing them. So how long do you give a product till you decide when to?
Again, it depends on the scale of the brand. So for us, it would be in the range of 6 months.
Okay.
So after putting in, see if this don't move in the right direction after 6 to 8 months, even directionally,
right.
So continuously say my ad dependency is in the same, it is not coming down. My conversions are not coming down or even worsening with time. So then we just say there is no PMF and there is no point in putting more money into. And sometimes it might not be a PMF issue. It might be a product market channel fit issue. So we have seen few products which did well in offline channels because maybe there's a slightly more higher price. People wanted to look and feel. Maybe we are not able to do justice to that on the listing and what could be done organically.
Got it. Now switching to the post-product market fit phase, again, we're still focusing on just the Amazon channel. Yeah. So you've gotten to that 10% of the TAM with 4.3.
Right.
So when you hit that stage, how do you, more in terms of, again,
account for future growth?
Yeah, planning for future growth, capital allocation. How should people think about it?
Yeah. So I think one is when it comes to future growth, right? So once you have reached 10%, so you should have a clear justification in your mind what percentage of TAM you would hit. So year 2 could be 20%, year could be 30%, as long as that is backed with your right product portfolio and all, right? If you think you have the right product portfolio, you have a right to win. And that's a very honest conversation that the founder should have with himself, saying, do I have the right product and to demand 25% market share in the TAM in this price point? So once you align with that, saying in the long run, I'll be at say 25 to 30%. Then you phase it out, saying year 2, year 3, year 4, how I'll get to it. And then your TAM will also increase, right? Because the category also grows. So in most categories, the premium categories are growing at a much faster rate than the overall category. So the category growth input you would get from the category team, right? Say, for example, the category is growing 50%. So year 1, say the market is 100, you do 10. Year 2, your aspiration is to do 20% of the TAM. The TAM becomes 150. So 20% of 150 would be whatever, right? Say around 30.
Right.
So that's how you'd plan your revenue numbers. When it comes to your marketing budgets, again, it comes in the same way. You need to plot the 3 parameters: ads, sales driven by ads, CPCs, and conversions. So these 3 parameters ideally should improve or should stay constant as you scale. I think that's the broad framework that I use and I advise people to use for planning growth on Amazon. It's a fairly simple framework to...
Yeah. No, it is. And quite powerful as well.
Yeah.
Now switching to offline, talk us through when you decided to, launch the offline channel. And if we can, discuss the pre-product market fit journey in offline as well, right? So just take us through your own journey when you decided.
I think the first time we tried to launch online was just when we started in 2015. Offline. We were very naive. Yeah, of course. So we went to the market, we went to this retailer saying, please let us talk. And they told us, just get lost. You are mad. Like this product at this price, by you people who have no experience, you cannot sell. So that was the first time that we tried to launch in 2015. Then, of course, we came back. But we were always clear that the market is there offline. So 90% of the consumer market is in offline, in fans. And I had a very strong belief, even in those days, that changing someone's channel preference is very expensive. So if someone wants to buy a ceiling fan offline, and I try to get him to buy online, that is where my marketing efficiencies will always go for a toss. And say, for example, I'll give my example. So I never like buying shoes online for some reason, for fit or something. But I keep seeing a lot of ads. So there's a total waste, right? And sometimes I even like the product. I want to try it out, but it's just that resistance in my mind that I always buy shoes offline. The same thing holds true for any channel. So whenever you are trying to change someone's channel preference, it's a very expensive affair. So the market was there offline. And we were always clear that we have to go offline at some point. And by 2017, we started getting feedback from consumers themselves saying, I like your product, but I want to see it because I don't trust you. And I don't trust Amazon also, because by that point we had exhausted the early adopters. So they're saying, I buy from my nearest retailer because something goes wrong. I go and ask him that it has gone wrong. So I like the product, I like the brand, but I'm not going to buy without the trust of the local retailer. So I think these things were happening in 2017. So 2018 is when we decided saying we need to go offline. So we started off with Mumbai. So for the first 1 year, we did only Mumbai. The reason was we wanted to fine tune our GT. So in our industry or in any industry, there are multiple GTMs for getting to offline, even for general trade, right? There is a direct dealer model. There is a distributor model. Some brands have a wholesaling model wherein you supply to some wholesalers and then the smaller retailers buy from them. Now, I think wholesaling was out of the equation because wholesaling usually works for brands who already have a very strong brand. Yeah. So I think we had to choose between, say, whether a direct dealer model or a distribution model. And we said the best way would be to pilot it out. So half part of Bombay, we tried with direct dealers, half part we tried with distributors, and then we figured out what the right GTM would be. So for a year or so, we did this. We figured out what the right GTM would be. We figured out that we had, a product market channel fit. I'll maybe tell you what the metrics that we look to arrive, whether we have a. And then once we fine-tuned, I think next year we're already getting a lot of online data, where our fans were selling, where the demand was. It was very clear that it was in South and West. 80% of our sales were coming from South and West, the 5 southern states and Maharashtra and Gujarat. So that year 2 was expanding into these 7 states and replicating what worked in Mumbai and replicating the same in the 6 to 7 states.
Great. And if you could just talk us through, the metrics that gave you comfort that you had a product market channel fit in the offline channel.
Yeah. So I think again, primarily, right? So the first thing was we are seeing a lot of repeats. So just like you look at consumer repeats in D2C, right? You look at consumer cohorts. So the same thing in offline is you look at retailer cohorts. So you open retailers and you look at M1, M3, M6 repeats. So the retailer cohorts were very, very healthy for us.
What's healthy in your like what would
in our category? It's if retailers are coming back, 70-80% of them are coming back and ordering every quarter. That's a very healthy metric for us. So I think that was one. Second is the throughput was increasing. So the same retailer who started off, say, with 5 fans a month, they had moved to around, say, 20 fans a month. So I think these are the 2 primary metrics. So one is the cohorts were improving with time. Second is the throughput was increasing per store. And third is increasingly we were finding it easier to open more counters. So opening the first 20 counters took us 3 months. The next 20 counters took us a month. So, and it was getting easier with time. So within 5-6 months, we understood that there's a product market channel fit. So, and of course, to get to there, I think what got there, I think a lot of inputs, a lot of scrappy things, a lot of non-scalable things to ensure that this happens.
Yeah. And tertiary is a bit of a black box in retail. Yeah. So how were you able to track that accurately?
You don't need to track tertiary accurately. I think if you track secondary, right? And see, without tertiary, secondary will not repeat. So at max, a retailer will purchase a product for the first time. But if tertiary doesn't happen, he will not purchase again. So I think we didn't put too much effort in trying to track tertiary. Of course, there are levers. I think we track warranty registration and all of those things. So directionally, we understand how tertiary is happening. But we are obsessed about secondary and not tertiary. And because if the secondary is happening again and again, without tertiary, secondary cannot happen.
Right. And, you said for a year you were just in Bombay. And, what sort of revenues, did you hit at the end of year 1?
I think we were doing around close to, 50 lakhs a month, more or less.
Got it.
Yeah. 40-50 lakhs a month, I think we had hit.
Okay. So 50 lakhs a month in year 1 and the other metrics you mentioned.
I think the other metrics, Again, it will depend from category to category. Other metrics will hold true. I think the revenue numbers, of course, will depend, but the other metrics on the retailer cohorts and all of this, I think we should improve. I don't know what the absolute numbers are, but the numbers should keep on improving. If these are not improving, that means you are doing a one-time activity, which will only show a one-time spike in sales.
Yeah, I think that's the sort of, important takeaway for everyone as well, because what I've seen founders always try to target is they assume that offline can, scale as fast as online and take unreasonably high targets on the revenue front. So for a year, you just hit the foundations in Bombay, got to 50 lakhs a month.
Absolutely.
Fundamental metrics checked off. And then you expanded into 7 states, you said.
Yes. Absolutely.
Okay. And, now talk us through that journey from, just being in one city to, now getting into 7 states. So, if we can apply the same framework in terms of what sort of growth rate aspirations, one should take in the offline channel once they hit the product market fit. Talk us through that.
So I think, again, we are not very obsessed about the revenue numbers. Okay. I think in the offline space, again, what worked, the same things, right? So I think reach was more important. See, we need to, I think in offline, we're primarily looking at reach and numeric as well as weighted distribution. So saying I need to be in the bigger counters and I need to be present in so many counters. So I think that was the most important metric in any market that we launch for the first 6 to 8 months. Because once, and of course the retailer cohorts and all, right? I think what I mentioned. So if this happens, right, and you continuously improve month on month. So if you continuously improve the number of counters built and you continuously improve the throughput from those counters, I think automatically your revenue numbers will keep on increasing. But if you have a primary target saying I need to do so much, that puts a lot of undue pressure and you'd end up taking a lot of short-term calls in terms of appointing the right distributor or dumping some extra material in some counters and that will ensure that you don't spend enough time on sellout. So on driving sellout, I think that's again a very important thing. In the initial 1 year or so, we did a lot of scrappy things, non-scalable things to drive sellout. So in the first year in Bombay, almost every weekend, I used to go to the counters, one of the counters, any of the counters, go and stand there for 6 hours, 8 hours, trying to sell from the counter myself. So, and that did 2-3 things, right? One is that gave a lot of confidence to the retailer saying this brand is serious. If this guy can come and stand in for 6-7 hours and try and sell the products. Second is it gave us a lot of learning in terms of what I think no amount of Facebook ad analysis or Google Analytics data or any kind of research will give you the kind of first-hand understanding that you get by pitching your product to consumers at the point of purchase. Because at the point of purchase, consumers don't lie, right? They cannot say, I like this product, because if they say, they'll have to buy it. So you get a lot of real-time honest feedback, a lot of scrappy things. We did a lot of society activations, electrician program, shop boy. So the focus was always to ensure how to get sellout from those counters. And there was no brand awareness, right? We started spending on brand much later. So without brand awareness, how do you ensure sellout? So a lot of these scrappy activities, non-scalable activities, we did it and it's still a playbook. So even today, for example, if I launch, say, a market in Assam called Dibrugarh, which I'm not there, I will repeat the same thing for the first 6 months. That I will do a lot of scrappy activity. The ASM will go stand there, try and sell himself. If we are not able to sell ourselves from a counter, how will the retailer sell at any point of time?
No, that's well said. And, I remember even Virat spoke about the importance of sellout, ensuring and the distributors, retailers getting confidence in the brand.
Yeah.
See, that's another one.
But I think all of this can only happen if you are not too obsessed about the primary numbers.
Absolutely.
But if you're obsessed about primary numbers, then your sales team is everyone is incentivized for that.
Yeah.
The moment you say, I'm obsessed about sellout, I'm obsessed about repeats. Right. If you place product in a counter, I need repeat from that counter. I don't need another 20 new counters.
Yeah, that's an important point as well.
Yeah.
Just defocusing the importance of primary.
Yeah.
Great. I think that was useful, Arindam. And, now the other question, when straddling multiple channels, one thing that founders grapple with is maintaining pricing parity, like you'll have your end of season sales on Amazon, etc. So how would you advise founders to think through pricing across channels?
So I think that's something that I strongly suggest everyone that you need to maintain pricing parity. I think there are 2 ways about it. Because if you do not do that, you will lose the trust of the channel. Somehow if the channel thinks these people, and for all digital first brand, that inherent bias is always there. So when we started, that bias, even today that bias is there, but it is reduced significantly. Saying that this is an online brand, they'll always sell online, they'll sell cheaper online, right? Because a lot of these retailers, they have lost businesses to online, right? So whatever online today, if e-com is today 10% of the GT, so that would have come from GT only, right? So GT is the one who's losing. So inherently, they don't like online as a channel. So I think if you give them any further reasons saying that you're finding it cheaper online and all, it's very difficult to build trust with them. So I think, and also it's wrong for the consumer. So consumers today feel cheated when they find the same product is available at different prices in different channels. So I think, of course, there will be trade-offs, but I'm a very strong proponent that you should have the same pricing everywhere, even though the cost of channel might be different in few channels. Some channel might be more profitable for you, let it be. But maintaining pricing parity for a single SKU, if the SKU is available everywhere across channels, is paramount. So even in those big billion days and all, our fans, again, hardly the discounts will be 100 rupees compared to what it is normally. You will never find a 3,500 rupees fan at 2,500 on those days. If that happens, that destroys brand equity, that destroys channel confidence. So
no, absolutely. Fully aligned on that.
But it's a very difficult thing to do because discounts are like antibiotics, right? So you will see immediate spike the moment you do a discount. But you do it 4 or 5 times, it becomes a habit and It's a vicious cycle. You cannot come out of this.
What's the maximum discount that you work with at Atomberg?
Yeah, I think we have a MOP. So in our category, the concept of MRP. So on top of the MOP, I think at max, we go around 7 to 8%.
Okay.
That will be the prime during, say, the big billion days or a prime day or something like that. But even that price will be higher than what the retailer buys at. So even if the retailer, on those days also, retailers will make a certain margin selling the products.
Got it. Okay. Now, if we have to bring this together, just focusing on Amazon and offline in terms of, I know you have a lot of metrics that you track and you've written about, but if you have to distill it down to say the top 3 metrics that you track on a daily or weekly basis, what are those?
I think it will depend on on a channel to channel basis.
And so let's take Amazon offline then.
Yeah. So I think for offline, right, I think again, it comes down to the same, I think the 3 things, right? I think one is for us, it will be, say, a total counter build. I think that is for every month, how many counters are built, what is the total secondary, and what is the new counter that we are opened. Because now we are in the expansion phase, and so opening new counters is also equally important. So I think these are the three metrics, I think, and which will be important. I think this is one metric. These are 3 metrics that I've been tracking for the last 4 or 5 years. On a quarterly basis, of course, you look at the retailer churn, the cohort data, and all of those things you look at. On Amazon, again, you look at what your numbers are, what your growth is compared to last year. Last year, same month growth, last month compared to last month, what the growth is. And we look at the overall tech costs, I call it, I think the total advertising cost of sales, that is marketing spends as a percentage of revenue for that channel. I think these are the 3-4 bigger, but we have fairly detailed dashboards which we run through every month.
Yeah, that is evident. Okay, now focusing on brand building a bit.
Yeah,
yours is a fairly infrequent purchase category.
Yeah.
So how do you think about brand building and essentially being relevant to the customer post-purchase in a category like yours?
Yeah. So I think slightly counter view I have on this. See, I think people really don't care much about brands. I think brands serve as a shortcut for people to make decision-making easy. People want brands to be in the background, right? It's like they don't want brands. See, as brand owners, as part of the ecosystem, I think we are much more obsessed about brands than a normal consumer is. So I think I think 2-3 metrics. I think one thing is your number should be there. I think spawned, total awareness, all of this in your TG. I think whatever number, the awareness metric should be there. As far as being relevance post-purchase is concerned, I think there are only 2 things. One is the product needs to deliver what it committed. If the product doesn't deliver, there's a negative. If the product delivers, you are relevant. Second is, in the worst case, if something happens to the product, you need to give top-notch customer service. And that is something that we have obsessed right from day one, because that's the reason why Atomberg is a very unique company where service has always been a front-end function. In a lot of appliances, consumer durables, you would see service is a back-end function with the only metric being the cost of service should be X percentage of revenue. We never look at it. So in our case, marketing budget is marketing budget plus service budget. So we look at it as the overall budget. So I think for us, being relevant is the product has to deliver on what it commits. And second is, if something goes wrong, we need to delight the consumer our after sales service. And the third part is, of course, I think at a brand level, I think you need to have a certain presence so that whenever they're in the buying journey, we are there in the initial considerations. So usually when you buy infrequent categories, you start with some 4, 5, say for if you're buying an automobile or a mobile phone, right? You always have these 3, 4 brands in your mind. It's important to be in that consideration set. Then, of course, with all your digital marketing and all, you'd need to, whenever they're in the evaluation phase, you need to win them in the evaluation phase. And then post-purchase, you just need to ensure that the product and service delivers on what it commits. I think that's the best way to stay relevant. I'm not a very big believer that people are fans of Atomberg. People keep on thinking about Atomberg. Ideally, they should not think about Atomberg much once they have already purchased. That's the best case scenario for me. If they're thinking too much about Atomberg, they will only think if something goes wrong with the product.
That's an interesting perspective. So, next focusing on culture a bit, what comes through in your posts is just that, very refreshing first principles approach to almost everything, etc.
Yeah.
So how have you created that culture in the organization? How
I think first principle is a hiring filter for us. So I think we check for that in the hiring process itself. So we over-index slightly more on first principle thinking and problem solving rather than saying whether you understand the industry or not. Because understanding the industry, understanding the category, I think those things can be easily taken up. Like if you, or say understanding any channel. So in our case, the entire e-com team, the entire ads team, the entire digital marketing team, none of them had any relevant experience before they started working. So even fairly senior people. So, but all they had was they had first principle thinking because everything else could be learned. So I think that's
and how do you test for that in hiring?
Yes. Sorry.
How do you test for that?
I think there are multiple ways, right? I think asking questions, just like how you test for problem solving in consulting, right? So there are case studies, there are examples, there are real world examples on the feet. How can people think with numbers, how comfortable they are with numbers and all of this framework driven? Do they have any mental models? I think so that's it. The second part is along with first principle thinking, there are some skill sets which you need to build. And in a fast-growing organization, what happens is those skill sets fairly evolve. Say, for example, I'll take my example, right? In 2017, I was running a 10 crore, today it's a 1,000 crore organization. So the skill set that I would have needed to evolve. So I think it's always very important to visualize 12 months down the line. Saying 12 months down the line, what will be the scale? And to do my role at that scale, what is the current gap that I have? And I fulfill it. A lot of people wait till they reach that scale. And then it's a disaster for all stakeholders involved. The moment I reach that scale, I will not have the time or bandwidth to invest and learn or talk to people and fulfill that skill set. So I think that's a culture that we're very open about it. I think right from the founders to everyone, I think we are very open saying we are all punching above our weights. None of us are qualified to do what we are doing. So we are not qualified to run a growth brand, right? Or any of one, whoever is leading e-com, whoever is leading digital, none of us are qualified and none of us will be qualified to do it next year, even if we are doing it today. So it's very important to understand the gaps and work today so that 12 months down the line, when that scale comes, we are ready for it and there are no. So 50-60% of the people are able to upgrade to the next level. And that's something that we have done pretty well in our course.
No, yeah. And along with first principles, the other thing that goes hand in hand is the learning culture. So you speak about setting expectations, but anything beyond setting expectations to nurture a learning culture?
I think a lot of things. I think there are a lot of freely available resources, etc. Whenever someone wants to get connected with someone, we facilitate it. I think, in fact, for me, I was very shameless in the 2017, 2018 phase where I reached out shamelessly to all people whom I thought are experts in their fields. So for branding, I would have reached out to everyone I knew or I could find on LinkedIn, FMCG giants and all, because they are the best people to learn branding from, right? Or say, for example, for service, I would have reached out to people. Even today, I reach out to people from Urban Company and all, saying, how do you do this? Can you teach me? And usually, I think that if you are very clear with your ask, open with your ask, and you respect people's time, people oblige. I think the ecosystem or in general, people oblige and people help as much as possible. That is one. And second is, of course, I think reading. I think there are enough resources. I think it's not the lack of resources which are there. It's the lack of will or the time that people puts in. Yeah. And also a lot of foundational stuff. A lot of people do a lot of fluffy stuff and things which are good to read. So for example, I would have read at least 3 textbooks on media planning before we started our TV, this thing. Now, I didn't learn TV planning from a blog or something. I actually read 3 media planning books which are taught in advertising or a marketing professional or marketing communication professional would know. So I think that culture somehow we have been able to build.
Absolutely. And I think it's also a matter of just leading by example and people know what you do and they follow. Maybe when we put out the recording, we'll share some of the books, etc., that you would recommend. So I'm just going to start we have a fair bit of questions, the questions one by one. Let me start with Kuldeep's question. So the question is, how do you evaluate market size on Amazon? I think he means when you filter it by pricing, right? So how do you get a handle on it?
Yeah. So I think the best way to do is you have the bestseller ranks, right? So you look at the bestseller ranks. I think bestseller ranks are publicly available. And you look at the number of ratings or reviews which are there. Usually, most products will have a rating review in the range of 2 to 3%. So say, for example, if a product has 1,000 reviews, you assume 2% review rate and you get to that number. That is one way. Second way is you talk to the category team. I think most category teams are fairly reachable, fairly open if you have reached a certain small scale. And the third is, of course, there are multiple party tools like Helium 10 and all of those, which will give you a keyword listing, and then you can create some kind of proxy saying if the keyword search volumes are this would be the market size. So I think these are three ways you triangulate and you arrive at a number.
Sure. The next one is Jitendra from Hair Originals. His is a category creation product on Amazon with little competition, and it's a high AOV product. So I think the question is, how should one think about benchmarks, etc., when creating a new category? I think the question is assessing TAM.
Yeah. I think category creation is it's a difficult challenge. I don't think there's any right answer for this, right? I think some categories were non-existent. Today, they are huge categories. Some categories, they did not grow. But I think it's independent of Amazon. I think if you think there's a category, I don't think you can evaluate. If it's a category creation play, you cannot figure out how big the category is. I think we'll have to have some proxies to come at it.
Yeah. So, Jitendra, if I can pitch in, that's how we think about it. It's essentially proxies. What is the customer using for that specific need today?
More be a top-down. So many consumers are there. Consumers have this problem. It's very difficult to do a bottom-up in a...
Yeah. The next question is from Jyoti. How did you get the first few offline distributors on board, since you're in a category where incumbents enjoy absolute trust?
Very difficult, I think. So this was more difficult than even getting the first investors on board. So the same story, right? You go to this.
We should learn from them.
So I think the first thing is you go to the retail market. You figure out. You ask the retailers who are the distributors in the market. So you would understand who the top distributors are in that market. So then you go to the distributor and you pitch him his business plan. On day one, of course, the numbers will be low. But again, just like you show the story to the investor on how the brand is going to grow for the next 3-4 years, you need to tell the same business plan to them, saying today you are here and this is how the brand is going to grow for the next 3-4 years. If you join me today, this is how your profits will increase in the next 3 to 4 years. I think so it's very similar to investor. He is just a partner. You need to convince him that the business has value. If he invests in the business today, he'll also grow with the business as the business grows.
Sure.
But easier said than done.
Yeah. I think the next one, what incentives or culture building practices you think has helped drive your sales team?
It's an obsessive focus on input metrics. So like for an event today, right? So how many counters you are visiting, what you are doing in these counters, it is more important than what numbers you get. If someone does numbers without focusing on the input parameters, I think that's something that we don't reward. So I think this obsession with input metrics is what has really helped us. And we continue doing it today. The moment you start, because I strongly believe that in a lot of categories, including ours, sales team can only do so much to drive sales. At the end, offline sales team, their objective is and visibility. As long as for them, the output, availability and visibility. For them, the input metrics are visits, quality of visits, retailer engagement, and all of this. The moment you start linking it with sales, primary sales and all, it becomes very difficult. As long as they are making the product available, visible, all the ranges are available, then all of these things, like I think that culture drives in. Of course, I think things like overall numbers and all also play, but I think all of these things come at a later point. Even today, a good chunk of our, scorecard goes into defining controllable outputs and inputs for them. The ultimate final sales number is not in their case, it is raining in Bombay. If it rains, numbers will go down. If they do not make their incentive because of rains, then they'll never be motivated to focus on the input metrics when I ask them to focus on.
And, you mentioned obsessive, and I've heard from people on some crazy things in terms of obsession, especially when it comes to tracking sales team performance. So can you double click on that? What does that mean in terms of frequency of tracking metrics, etc.?
I think one is the number of visits that you make. Second is whatever beat you are planned, how much you are adhering to the beat. So I think these are the two metrics which are very, very critical. Saying, for example, if I plan to visit a counter Monday morning, 11 a.m., I need to visit that counter Monday. There is no ifs and buts. I need to visit. I need to do my 4 activities. What I need to do, I need to take a photo of the branding. I need to speak with him. I need to clear his all previous dues, whatever it is, scheme settlement. So we have a SFA, which is a very enabling tool for us. It shows if you go to a counter, one thing that you need to do, you need to complete all of those. So this is the obsessive input metric. The output metric for them are availability and visibility. They need to make the products available, ranges available, and visible because these are in their control. Now, after doing all of this, if sales is not happening, consumer walk-in is low, whatever it is, then it's a much bigger problem which they cannot directly influence.
Okay. The next question. I'm curious to know that although you designed the product with the USP of energy efficiency, how did you realize and adapt once you realized people were getting hooked because of the remote control?
No, I think that was the early adopter. So what happens is, what we realized very early, there were 3 different TGs for us, 3 very unique TGs. So one was these early adopters, tech guys, engineers and all. They were obsessed with remote. For them, we launched the smart variant, which is Alexa enabled and all of this. Then there is second TG, which is say who want the fans for interiors. For them, fan is a part of the home decor. They want good, sleek looking fans with interior. They spend a lot on their interiors, the architects and all. So that's the second big segment. And the third segment is people who are value conscious, for who make a very rational decision. I buy this product, I save 700, 800, 1500 rupees a year. And that is why I pay the premium. So I think we figured out very early in our journey that there are 3 unique segments. Like digital communication was very separate for each of these 3. And when we went broad, I think it's a mix of all of these 3. You would see in our ad, we'll speak about energy efficiency, we'll show the remote, the looks of the fan anyways is shown. So all of these things come into play in the overall brand communication when you do.
Okay. The next one is on influencer marketing. How big do you think influencer marketing will play a part in the pre-market fit and post-market fit journey?
I think it does play a role across categories. Again, it depends on which category you operate. Some category which are more Instagram friendly, you need Instagram influencers who show the product and all of this. Categories like us, which are more evaluated, right? People go to YouTube and search for reviews and all of these things. So in categories like us, I think YouTube influencers, unboxing, product reviews, I think those things become more important. But figuring out what you are using influencers for, I think that is very important. Whether you are using them for building brand awareness or generating trials or getting people to trust the brand, I think the right objective is very important on why you are using influencers.
Right. The next one is Atomberg's products are more technically advanced versus competition. In your initial days, did you see Amazon ratings on the lower side as the consumers didn't know what to expect?
No, I think we did not do. So for the consumer, it was a fan, right? So they didn't really care what the motor was and all. As long as the fan performed, saved electricity bills, gave good air delivery, worked with the remote, I think they were very happy.
Okay. The next one's from Nivedita from Air. With regards to brand building, how would you weight online channels for establishing trust, brand presence versus, I think, performance marketing? Were there any specific marketing initiatives that worked better than others?
I think overall, I think what it worked was, I think that focus on ATL for us, I think that really worked. I think once you reach a certain scale, like when you are present on a bigger screen, on a TV, right? I think that really takes the brand to a next level. And how this works usually. Say, like when you're seeing something on digital, right? Because everyone knows digital doesn't cost a lot of money. So that's a framework that's a mental model that consumers have, saying I'm seeing hundreds of ads, you are just one of those ads. But the moment you are there on, say, even on a regional ATL, right? The number of brands which advertise on regional ATL will be much lower, say will be 100x lower than what the number of brands which would advertise on Facebook or a YouTube. So I think being ATL, I think other than the things like awareness and all of those, other than the logical things on how ATL is better, way how ATL worked for us is in building trust. Saying if this brand is spending money on TV, if this is there on TV, it is a brand which is there for the long run. I think that's a belief that a lot of retailers, distributors have. And even today, right, I think although the recent funding boom and all allowed a lot of non-sustainable businesses also to advertise on TV. But historically, over the years, brands that advertise on TV are fairly large brands, big brands which have reached a certain scale, and people associate TV with trust. And that's something that has worked well for us in building trust and in the overall mix.
I think the next one is on any inputs on how you went about building your sales team specifically.
Again, very similar. I think we focused on people who believed in the input parameters more. I think a lot of bigger organizations, what happens is because the brand pool is so high, right? You don't need to have that rigor in the market. So I think we were very clear saying that this will require a lot, even today, right? It requires a lot of legwork and that input metrics are very important for us. I think so that was one thing. Second thing is we tried not to hire from leaders. So we would always hire from a number 4, number 5 brand in a market because they know the struggle and they see the struggle, they hear rejection on a daily basis. And for a startup, when you're going offline, I think you would hear rejection again and again. I think for me, when I was doing GT for the first year to open a counter, I think it took me at least 5 to 6 visits. For the first 3-4 visits, he would not even let me enter the shop. He would just say, please get out. I think in the 4th or 5th visit, he would come offer me tea. And only in the 5th or 6th visit, he would say, okay, you place the... So you'd hear a lot of rejection. So you need people who can handle rejection and who are open to... So a lot of freshers, a lot of young people. And that's what I think. I think relationships and all these things are slightly, I think, we over-index on the importance of this thing. Saying, I need people from the... Okay, of course you need people from the industry. But do you need everyone from the industry? Maybe no.
No, that's interesting. Hiring from the 4th and 5th. With regards to your initial Google and Meta ads, did you send the customers to your Amazon page or D2C?
No, D2C.
Okay.
So we have always sent people to our D2C website because we thought let people come to the D2C website, let them get all the information because my D2C website allows me to tell the story in a much better way. And then let them make the decision from where they want to make the purchase.
Right.
Whether it is from Amazon, Flipkart, D2C, offline today. So that's the framework that we have followed.
Yeah, maybe last 2 questions. Your thoughts on how to incentivize distributor sales. I think now they're talking about how you use distributor sales force.
About distributor sales force.
That's visiting retailers. How do you incentivize them?
Incentivize retailers?
No, distributor sales force.
So I think the distributor sales we don't incentivize because distributor does 3 things. Distributor is not responsible for sales. Distributor is responsible for ensuring that the products are supplied on time. The distributor is responsible for helping you identify the right counters in that market on which the product should be available. And thirdly, the distributor is responsible for giving credit to the retailers. I think these are the 3 things that the distributor cannot be responsible for increasing your sales. At least not for the first few years of the brand. If you are doing that, then you don't have control of your sales. Then you are as good as a wholesaler, right? The distributor is selling wherever he wants to. For us, we are very clear distributor is solving for only these 3 things. Distributor is solving for identifying the right counters, supplying products on time within 24 hours to the retailer whenever the retailer needs, and giving credit to the retailer.
I think, we have more questions, but I've taken 10 more minutes. So thanks, Arindam. Really appreciate it. One last question before we wind up. So, for those listening in, if they want to be Arindam, what are the, personality traits, habits that you think could get them there? I
think there are 2-3 things I think which I do. Again, nothing unique or something. So one is perseverance. So I think that's a trait that is there key. And I think that would be a trait which will be there with most folks in the startup ecosystem. Key. You just need to survive long enough. If you survive long enough, you will get lucky. And continuously focus on the input parameters without worrying much about what the outputs would be. Second is again hard work. Again, this might divide opinion. Today you hear a lot about work-life balance and all of these things. But I think that's a trade-off, right? If you really want to do great things, you need to put in the hours. Put in the hours to learn, put in the hours to... Because if you are trying to do 2 things at the same time, right? You are trying to upskill yourself, learn new things, also ensure that the day-to-day operations are having. So usually, I think hard work is something that in most rooms, I am the most hardworking people in at least within Atomberg. And of course, the third thing is key. You question status quo. I think you don't just accept what works in the first principle thinking. It's not that if something works this way, it needs to work this way. I think if you question things from first principle, you would figure out a lot of things are not done fundamentally right. And maybe that's an opportunity for you to do that right. So I think, these 3 things are something that I would associate with my personality traits: hard work, perseverance, and first principle thinking. No, that's amazing. There's one line that I use always. This is from Jeff Bezos. He likes to call it work-life harmony, not work-life balance. It doesn't have to be at odds with each other, actually.
But thanks, Arindam. This was fantastic. Learned a lot and really appreciate the time.
No. It was a pleasure, and I hope the people who are listening or who listen the recordings would find value in whatever we spoke.
Perfect. Thanks, everyone.
Thank you, everyone.
Have a good evening. Bye.